Hi, my name is Dmitry Tikhomirov. I am PhD in economics and associate professor in High Economics School. We discuss with you financial modeling, presentation, and visualization of results in Excel and in PowerPoint. What we need to discuss? First, express review of the financial model. How to understand whether generally the results of the financial model are reasonable. Then we move to comments to the financial model of some investment project. Then we move to sensitivity analysis and scenario analysis, presentation of graphs and tables, presenting results again in Excel and PowerPoint, just some selected items and selected graphs and tables and diagrams, and then we briefly discuss useful formulas and links in Excel in financial models. So first, we have to discuss express review of the financial model, reasonableness check of the results. So first we discuss reasonableness check, which is used to review the results of some financial model, maybe very complex or average size and complexity financial model, by the market approach. We understand that the model is generally presented, it's kind of future incomes and future expense, it's kind of the income approach, whether this is a financial model of a project or this is the income approach and business valuation, and we take this financial model and we review the reasonableness of results by application of a simple market approach methodology. Again, we see application, new business or project under review of the bank. It could be a calculation of NPV, or calculation of fair value of equity, or fair value of invested capital, whatever. What we see here on the slide, we see forecasts of revenue, and we see here that they start from zero, and we see increase in revenue. Then we see forecast of EBITDA, then profitability. We mean EBITDA, so it's relation of EBITDA to revenue. Then we have forecast of CapEx, capital expenses, and NPV. We need to say that this is some extract, just an extract from a big, much bigger than this table financial model with different details, how we calculate revenue, how we calculate EBITDA, etc. But we need to check whether these results of the model are reasonable. Why we want to do this simple check? Why we do not want to do detailed analysis? Certainly, in most cases, we need to go into all details of financial model and try to adjust, try to correct, try to ask questions, and we certainly have a lot of questions. But we, in many cases, understand that this will be very time-consuming, and the financial model may have different mistakes and areas for improvement, and we will spend several weeks or months on these adjustments and negotiations and communications. So we just decide to discuss some extract from the financial model. And what we see here, we see that the company plans to spend in total 2 plus 2 billion rubles, so in total 4 billion rubles, and in some period of time they will reach some operating stage of this business or project and will receive some stable revenue and EBITDA of let's say 440 million rubles per year. And then they will go to some long-term growth, to some perpetuity for next periods we do not see here in this extract. And we want to understand whether we need to go into this business and project or not. let's speak about market approach, about EV to EBITDA ratio. We ask the company, what is reasonable EV to EBITDA ratio in this business? Let's imagine they say normal multiple that we may buy business tomorrow is 6 or 7. We say, okay, let us be even more optimistic. Let's put multiple of 8. So we are quite loyal to these results and we are quite optimistic. So if we take multiple of 8 and we multiply by EBITDA of 2025 of 440, as we have seen on the previous slide, we will have enterprise value or business value at that point of time, something around 3.5 billion rubles. But this value will be at some point of time in the future. So if we discount to current time, to current value, let's say beginning of 2022, we do not know what discount rate will be, what adjustments we need to make, but certainly it will be lower. So approximately current value of this total business or project will be from 2 to 3 maximum billion rubles. So now we may compare this current value or range of 2 to 3, very approximate, I agree, with the amount of capex that they plan to spend. And we have seen on the previous slide that they plan to spend 4 billion rubles on capital expenses for this project. So we ask ourselves, is this project acceptable? Probably looking at this, it's not acceptable. And we need to understand why the company, the current initiators of this project, want to do this. And there could be different reasons. Reasonable objectives and aims or completely unreasonable. One of these aims, which is not acceptable for us, for investors, for other investors, for banks, is that the company, the current initiators of the project, they want to make profits on the capital expenses, not on future development of the company, not on operating stage, on the cash flows and profits that will be at some point of time in the future. But they want to make most of the profits in the beginning on the capital expenses because, for example, they may select their own subcontractors, their contractors, and effectively they will spend much less on the project, but they will say that they plan to spend 4 billion rubles, but out of these 4, only half, let's say, will be effective expenses and half will be just their profits immediately. So this simple example helps to ask questions to the company why you want to do such a project if it looks not really reasonable when it make it in a simple table. And again, if you will finally go into all details of the financial model, it could be needed for you later, but it could be difficult because you will see slightly unreasonable assumptions in many aspects, but most of them will be in some possible reasonable ranges. For example, revenue a little bit higher than normal, but more or less acceptable. Costs are a little bit lower, but also could be. Discount rate a little bit lower than normal level. So point by point, assumption by assumptions, most of these assumptions look more or less okay, but in fact, the table as we presented in a clear and nice tables, we understand that probably this project is not reasonable to undertake. Now we move to sensitivity analysis and scenario analysis. We discuss just some examples of graphs and tables and presenting results in Excel and PowerPoint. Here we see some extract of the output list or dashboard with just part of major information about some project or business. We see just a name and brief description and block with different switches and buttons for selecting different changes in assumptions. For example, changes in prices, in quantities, in capital expenses, in operational expenses, whatever. Yes, depending on the particular needs for the project. Yes, what you consider reasonable, they should be reflected in these buttons to be able to change these scenarios. And then you have a lot of different ratios and forecasts and diagrams or graphs with the major forecasts presented in the graph format. For example, we have like cash flow, different repayments of debt, repayment of interest, and then debt service coverage ratio, and whatever you want to be presented here. Risk assessment could be done in financial model in different ways. You may just adjust different assumptions and calculations, and by doing this you will take into account different risks. But additional tool is sensitivity analysis, and also second type is scenario analysis. You usually do sensitivity analysis of the major ratios, for example, debt service coverage ratio, NPV, IRR, whatever, to the major assumptions, to the change in major assumptions. For example, price, quantity, timeline of your project, or whatever. And scenario analysis, you select different, again, ratios and select different assumptions and construct different scenarios. Here we have presentation, tables, graphs for the purpose of document preparation. Here we have some table for changes, understanding the changes in major ratios, in NPV, debt service coverage ratio average, debt service coverage ratio minimum, and particularly by different years in your financial model. And we see changes in different assumptions. So what will be if we change price? So we have basic scenario, then we understand the effects of the price plus 5%, minus 5%, then we change volumes, different cost of goods sold or other expenses, capital expenses, whatever you consider reasonable here. And this information in Excel format for your convenience will be additionally presented, so you will be able to download. Here we see just an extract here in the hard copy format. When we speak about sensitivity analysis, we have simple cases or more detailed cases. Here we see just a simple case, usually used in the valuation reports, for example, when some consultants prepare independent valuation calculations, they like to include such tables. So they have some basic value for example, NPV, equity value, enterprise value of business in the middle of your table, you see here, and also they present that changing some assumptions, for example, retail prices, cost of goods sold, capex, whatever, you also see how, for example, NPV or other ratios will be changed. And then you may also select some range that you consider reasonable. So you do not say that all these figures are reasonable and you absolutely do not know what to select. You say this is my basic figure and result, and also the most reasonable range you somehow highlight by additional color as presented here on this slide in light green color. What is also important here to understand the difference between sensitivity analysis and scenario analysis. In sensitivity analysis, you do not conclude finally what is reasonable. You just present information how your results will be changed when you change some assumptions by some usually small or not so small changes. For example, if price will be decreased by 1%, 3%, 5%, and 10%, your NPV will be changed appropriately. When you present scenario analysis, this is similar story, but a little bit different, because you construct already different scenarios, may be changing different assumptions. For example, you may say, if I will reduce price by 5%, but plus I will delay my project for half a year, plus I assume that cost of sales could be 5% higher, or exchange rate will be a little bit different. So finally, taking all this, this is my conservative scenario, for example, and results will be as follows. So approach could be different, but this is the main difference between sensitivity analysis and scenario analysis. On the next slides, we will see some examples how to provide and to present information in PowerPoint or in PDF, in different investor presentations or business plans. For example, business plan could or should include sensitivity analysis of key indicators to key factors like here. These are key ratios that we may test for sensitivity or provide different scenarios for. For example, NPV, we are really interested how NPV will react to different changes in your assumptions. Then debt service coverage ratio, average for your whole period of your project, or debt service coverage ratio minimum out of all different ratios in your all forecast period. Then payback period, discounted payback period, loan life cover ratio, some other EBITDA margin, and some other ratios. Here we see on this slide, we see different factors. So what we will change in order to check different results. So we may change discount rate, raw material price, selling price, production volume for in our project, capital expenses, transportation expenses. We may assume delay in project realization. And by the way, these delays could be applied in the model by different approaches. So for example, you may delay all your cash flows like proportionally. So you will start your project later and you will start your operational phase or consistently later. Or you may assume that investment stage is not changed, so you will invest in your project from today till the end of this year, but you will have delay only in relation to your operational stage. And this could be also a different approach and maybe even some other approach to changing these terms. And also exchange rate changes. So you may play with different forecast exchange rate, because honestly nobody exactly knows what exchange rate will be in the future. And here we have this just a similar example to the previous table, where we have changes in discount rate, changes in selling prices, and finally we say that the reasonable range of fair value or NPV of this project is somewhere within 3.7 to 11.9 billion rubles. This is possible range when you will increase discount rate from 0%, like you do not have just adjustment to discount rate, or you slightly increase by 1% and 2%, and when you will reduce your selling price in the in your forecast period. Certainly this will be quite a conservative scenario, and this will be minimum figure in your reasonable range. So this will be 3.7. If you do not change discount rate, if you do not change selling price, you have more or less optimistic NPV of 11.9 billion rubles. On this slide, we see some kind of a summary of different scenarios and different information or ratios that we are interested in. So, first we have basic scenario and some additional, but let's look what we are interested in. We need to understand information about the loans to be provided or already provided to this project. So, we see that in basic scenario, credit line of the bank that needs to be provided to this project is 25 billion. Plus, they require 10.9 billion to refinance or restructure of the current loan. So, approximately, we speak about financing of this project in the amount of 36 billion. Also, it's stated here additional credit line. It's not stated here, but we can guess that usually this could be for some cash deficits or just compensation of some additional expenses in the future in order to maintain normal, stable business. So in the future, you maybe will need some additional credit line of maximum 12.5 billion. Then we see repayment term, and repayment will be somewhere between 2030 and 2032, so approximately 8 to 10 years of the loan. Then we see interest rate of the loan. It could be a range, because maybe it will be provided by different tranches and different conditions, but something around 10, from 8 to 12.5%. We see NPV in the basic scenario and IRR of this project in the basic scenario, which is 17%. So in basic scenario, it looks acceptable generally because NPV is positive. IRR looks like higher than possible discount rate, but certainly the questions will be whether the banks want to provide these finance loans to be provided, and whether they are happy with the conditions and whether they are happy with the assumptions, because this is basic scenario. And banks or some other investors try to calculate additional, more conservative scenarios. For example, second scenario, transportation tariff without transfer of railway road. So maybe there are some negotiations that that your railroad included in your project should be transferred or not transferred to some monopolist, Russian Railways or whatever company. So maybe the government will buy this railroad or do not buy. So this is second scenario. Whether this will be or not will be transferred to the government, to some another company. So it's stated here that without transfer, your ratios generally will be not so good, because you will first need to have additional credit line, yes, and your NPV will be lower, your IRR will be lower, and maybe some other ratios will be a little bit lower. Why? We do not know here, because we, in order to understand details, we need to go into financial model itself. But here we see already the answer for this. Then what we see? Scenario number 3, price adjustments. For example, starting from some period in the future, 23, 25, whatever year, we decide not to significantly increase prices for our product in accordance with some forecast of analyst reports, but just to inflate. So we to inflate by some long-term rate. So we are doing here more conservative assumption about your future prices, and this directly leads to much worse results, particularly NPV becomes negative, IRR ratio becomes very low, etc. Yes, and next scenario, capital expenses increase by some volume, for example, in our case, 30 billion ruble, which is around 10%. Again, here we see that your credit line will be higher, new credit line, additional credit line, your NPV will be lower, etc. But what will be really useful here? To present on one slide, on one page, not only this information, but also to include information about your assumptions in each of these scenarios. So to list most of assumptions and factors in the basic scenario, and then to present some in very small tables or bullet points, present information about changes in other scenarios. In our presentation here, we present it on a separate slides later. But again, I recommend that you try in real reports, in real life, to try to present this on one slide, because this will be very convenient to see everything and not to jump between different pages. And also, this one slide will be also uploaded for you, so you will be able to understand how it will look if you present everything in one page. Here we have information about base scenario assumptions, about exchange rate, selling cost, additional shareholders' capital, whether they need to invest or not, then what is the required debt service coverage ratio, what is the story about transfer of railroad, etc., etc. And then we, on the same slide, present different assumptions for different scenarios. For example, as we discussed, story about transfer of railroad, so we see different tariffs when you transfer, when you keep the railway in your project, you see different tariffs, different expenses probably. This will be useful for you. Then prices. Again, we have basic scenario. We see that prices in some years like 25 or 30 or 32 in basic scenario are increased, but in conservative scenario, they are highlighted in bold here, they are lower. Again, we understand what is going on with this assumption. The same story with capital expenses. Basic scenario capital expenses year by year and increased capital expenses by 10% or 20% as you wish to do in your particular scenario analysis. As we have just discussed, there are a lot of different ways to present information about scenario and sensitivity analysis. One of possible ways also is to present break-even threshold analysis. In this case, you present by how much you need to change each assumption in order to, let's say, kill your ratio down to zero. For example, if we speak about NPV. What we see here, CAPEX plus 146%. This means that we need to, in order to make our NPV equal zero, to kill our NPV in the project, we need to increase CAPEX, capital expenses, by 146%. So approximately 2.5 times. Discount rate, we need to approximately double our discount rate. For example, in basic scenario, it was 12%. Then if we apply 23 or 24%, then our NPV will become zero. Then, what is more interesting here? Whole range volume, so volume of our products. Let's imagine here in this example, we produce three types of different products, concentrate A, B, and C. And if we reduce production of all and production and sale of all these three items by 30%, this will again bring our NPV to zero. If we will play with individually with different products, this may lead to some more difficult issues and cause some problems. Because you see here that concentrate B, second type of the product, if we reduce production and sale by 39.8%, this will individually, yes, only individually this concentrate B, this will bring NPV down to zero. We do not change here production of A and C. But if we change production and sale of A, some, I don't know, 10%, 100%, 1000%, whatever, or we change production and sale of concentrate C as much as we want, this will not finally lead to NPV of zero. Why? Probably the question that this production and sale of these products individually, they do not form significant part in our sales and finally in our profits to be able to kill NPV to zero. So we may fully refuse from this product. Yes, we may forget about this A, still our NPV will be positive. We may forget about product C, still our NPV will be positive. And similar story with prices lower. Yes, you have whole range of prices, and if you reduce all your prices by 28%, the NPV will become zero. But whether you change price for product A or product C or even product B, individually, if you change prices, even sometimes down to zero, you will not be able to kill your NPV in full. Okay, and we have also additional break-even analysis here for operational expenses, for transportational expenses, for USD exchange rate, for interest rate, and for all the factors that you consider reasonable in your specific project. Now we move to the last part of our lecture about useful formulas and links in Excel. We need to remember that most of models are prepared in Microsoft Excel to make it possible for all parties to review and understand these models. There are sometimes some specific tools and specific applications and programs, but 99% of financial models for investment projects, for project finance, for business relation, even from the top biggest and the most recognized consulting companies are prepared just in Excel. And we have already discussed best practices. We understand that it's not possible to present and to provide one for all cases financial model, but everybody needs to try to maintain good and proper level of detailization of presentation. And here on the screen we have just example of one of the major slides of the financial model with most of important information for checks, that all checks of your financial model are okay. And we do not see here what checks you have done. They are presented on a separate slide, probably that your statement of financial position is balanced, that you have positive cash flows, your equity is positive in all your forecast periods, etc., etc. But you see here that everything is okay. Then you have on top of the financial model result. In this case, for example, we have result for NPV. Why we need to have this? This will be useful when we play with the financial model. We change some assumptions, and we will always see whether your NPV decreased or increased, or you remember that this is your basic NPV, so you clearly understand that this is the basic scenario of your financial model you are now working on. Then you see next periods of your forecast period. This could be years or quarters, for example, then different headings, subheadings, different units, etc. So this is just an extract from some financial model here. Key useful Excel functions we do not discuss now in details. You will be able to download them just in more or less the same list after the lecture. But the most widespread are minimum, maximum, average, sum if. Sum if is in most of cases used, for example, to to present information that is in details calculated by quarters, but when you present information by years, so you sum if information for each year using this function. Then count if, based on some criteria, some product when you multiply different components, if, or, and end function. And as we discussed, if you certainly in all models you use if, but you do not need to overuse and not to use a lot of different if, and if in the same cell, because if needed, you need to somehow simplify this and use, as we discussed, different flags. For example, 1 or 0, yes or no, true or false, in order to reduce number of ifs within each cell of your financial model. Then you have a function is error, round up, fraction of a year, choose, index, match, and different other functions, which is certainly not convenient to demonstrate from the screen. So you will see in additional Excel file in your materials. And finally, what is useful when we speak about construction of scenario and presentation of information in financial model is different ways to use different buttons and chooses in these scenarios. Let's imagine you have some information about production of different items of your products, porcelain, iodine, some other. And you have a forecast for, let's say, 3 next periods. 100, whatever, different volumes. What are ways to present different buttons and scenarios? First, here we have so-called, this is not official, selection. When you will be able to put tick mark for each of the products and select these products. When you remove tick mark, for example, you do not believe that you will produce chlorhexidine in your project, or you understand there is significant doubt in this production and sale of this product, so you just remove this tick mark and your volumes will become 0 in this table and finally in all your financial model calculations. Again, we here just discuss this from the screen and more details how to do this and examples in Excel you will download after the lecture. Then you may have choose button. When you choose just a number and you select the product, chlorhexidine, iodine, whatever. Then a little bit different, but in idea absolutely the same, choose button when there is a button itself and a list of different items. Again, you select and you have appropriate product selected in your forecast. And again, you may link to your financial model, and this will result in your final ratios changes. And also, you may have a tick mark when you select just some, not some, but one of possible products, and this product will be automatically selected and reflected in the table here. Additionally, you may have kind of scale or kind of a bar. Let's imagine in this case we have the table of raw data as 3 slides before, but this is like a maximum capacity and you want to play with utilization of your capacity. Maybe you will produce 100%, 90%, 50% as in this case. So you will, by this bar, change this utilization, and this utilization ratio will automatically affect your final results in the table below. Now we have final conclusions regarding financial model here. Financial models may be not optimal in terms of logic, architecture, formulas, and other issues. Most of models are prepared in Excel, in Microsoft Excel, to make it possible for all parties to review, to understand, to play with this, and even to make changes if needed. The main idea is to simplify calculations and presentations where possible. but not to compromise quality and level of detailization when needed for your final result, certainly. Financial model always implies risks and uncertainties in the forecast, and sensitivity analysis and scenario analysis should be tailor-made to reflect risks of the business project, of particular business or project. Yes, we again emphasize that you need to do sensitivity and scenario analysis only for the factors that you consider reasonable for your business or project. And review of the financial model may be different from detailed to high-level understanding of results and reasonableness of ratios.